All right, welcome back to another edition of Intermediate Accounting 1. We're going to continue on with Chapter 10, Learning Objective 3, and specifically we're going to talk about how we acquire an asset with doing more than just simply buying one particular item for cash. The first one I want to talk about is the lump sum purchase, which is also what I like to call buying in bulk. And the way we determine the cost per each asset in a basket is we determine the cost based on the asset's relative fair market value. And we'll look at examples for that one. Also, what we want to do is look at what if we don't, a situation where we don't pay with cash, we actually give something else of value, such as our own stock. And if we issue our own stock, the market price of the stock issued is the fair value of the cost itself, the cost of the property acquired. And we'll look at examples of that. So basically, if our stock's trading at 20 bucks a share, hey, if we issue one share, we get 20 bucks worth of goods or services. The last one, which takes up a little bit more of the bulk of our time, is the exchange of non-monetary assets. Property, plant, and equipment in such a case is recorded at either the fair value of the asset given up or the fair market of the value of the asset received. And I give you lots of examples in the Chapter 10 homework. So let's look at the valuation of PP&E when we have lump sum purchases. When the company purchases assets in bulk, what I like to call in bulk, the company pays a lump sum price for a basket of assets. So when the idea behind here is why would we buy assets in bulk? Well, the idea behind buying assets in bulk is the same reason why we buy any type of goods at Costco, is that purchasing assets individually will usually cost us more than if we purchase assets in bulk. So we save ourselves a little bit of money per unit or per each item if we buy in bulk. So if we want to buy land, yes, maybe there is a building already existing on the land. We don't really want the building, but maybe there's some value to it. The seller offers both the land and the building at relatively discounted prices than if they were sold individually. So that's the reason why we would buy in bulk, is that it's cheaper on a per unit basis. The question comes down to this: how do we allocate a lump sum expenditure to each individual asset in the basket? Well, we could just simply take the overall purchase price, the lump sum expenditure, and we could divide it by the number of units. Well, that doesn't really work if the units, the things we buy, are heterogeneous, if they're different in nature. If we're talking about Costco, we buy a bunch of toilet paper, ha ha ha. If we buy a bunch of toilet paper in bulk, yes, we can take the price we paid for a bundle of toilet paper and divide it by each individual roll of toilet paper inside. Those toilet paper rolls are all homogeneous, they're all the same. But we're not talking about those situations here. When we're buying assets, usually the things that are in the basket, quote unquote, are very, very different. So what we have to do is we have to allocate the lump sum expenditure based on each asset's individual fair value. Now, to give you an example of what's going on here, here's an illustration. Norcut Homes Inc. decides to purchase several assets in a small heating concern, some type of business, if you will. Comfort Heating is the seller, for $80,000 total. Comfort Heating is in the process of liquidation. Its assets are sold as follows. So, on the seller's books, the seller has inventory, land, building, totally $85,000. But the seller is willing to offer us all of that stuff for $80,000. If we want to figure out whether or not that's a fair price, typically what we would do is we would hire a consultant to go out and determine the fair market value of each individual item. And if that consultant tells us on a market basis the inventory is worth 25, the land is worth 25, and the building is worth 50, we can say, well, on the seller's books, it may be a book cost, a book value of 85,000, but there's an overall fair market value of 100,000. So some people tend to look at that and say, oh, we must be getting a heck of a deal if we're offered this whole bundle of goods for just 80,000. Well, not exactly. See, here's the deal. Most people tend to want to calculate whether or not they're getting a good deal on each individual item. So if we took the book value and we subtract off the fair market value, we could say that in the case if we were offered just the book value of these items, that there is a $5,000 gain to us if we're buying at book value. In the case of land, we could say that, oh, we're paying over by $5,000. Or in the case of the buildings, we could say that we are potentially getting away with $15,000 a steal. Well, we're not being charged $85,000. Remember, we're being charged the overall $80,000. So going back up, realize that this is the overall amount that we're spending. We are not paying whatever the seller's book value is. So we're going to ignore that. Also keep in mind that even though there may be a difference between the seller's book value and fair value, we don't really care so much about that either. The only thing we really care about is this number. What is the total fair market value of the basket, the total basket of goods? And down below, I walk through a situation where I say, okay, look, here is the total fair market value of all of the items in the basket. And what we can do is we can take each one of those items and divide it by the 100,000. And if we do that, we can figure out as a percentage of total fair market value, what is the value of inventory? 25,000 divided by 100,000 is 25%. 25 divided by 100, 25%. 50 divided by 100, 50%. So what we can say is that inventory is worth 25% of the overall fair market value in the basket. Land is worth, as a percentage of total fair market value, 25%. Buildings, the building we're buying, is 50% of the overall fair market value. If that's the case, then we just simply multiply it by 80,000, the cost we pay for each individual good. And when we do that, we can say that 25% of 80,000 is $20,000, 25%, $20,000, and 50%, $40,000. This is the true cost of each individual item when we allocate based on the percentage of total fair market value. Total is still 80,000, but we broke it out between inventory, land, and the building. So down below, what do we record as the overall cost for inventory? We would record 20,000. What's the overall cost basis in land? 20,000. What's the cost basis in the building? 40,000. And how do we know that works? Because this is the true amount that we actually spent on the goods. Now, you may have seen this before in Accounting 2300. If you haven't, hopefully this is a pretty straightforward example for you. This is about as complicated as I want to make it for you. If you have any questions about this, please let me know. Post your comments or questions in the discussion board. I want to move on next to valuation of PP&E in the situation where we issue stock for assets. When a company purchases an asset, not with cash, but with its own stock, we can actually issue stock as a secondary equity offering. Typically, when we issue stock, the first time we issue stock, it's called an initial public offering. If we want to offer stock to the public again, we would call that a secondary equity offering, SEO. That's the second time. But we can also issue stock privately. We still have to register with the SEC, but generally speaking, if it's not a material amount of stock that we're issuing, we can issue our own stock to purchase a special piece of equipment. So this works out pretty well for us if a company's stock has value, especially if it's traded on an active market like the New York Stock Exchange or the NASDAQ. The question comes down to this: how much do we record as the cost of the assets acquired, the asset or the assets acquired? Well, it's kind of the same thing we did in the case of a lump sum purchase. We use the current stock price of the company's stock to determine the cost of the asset acquired and any excess above par value, otherwise known as a PIC or APIC. And so I want to go through an example with you next. Oops, Kevin. Illustration. Upgrade Living decides to purchase some adjacent land for expansion of its competing carpeting and cabinet operations. In lieu of paying cash for the land, the company issues 5,000 shares of common stock with a par value of 10 and a market value of 12. So when you see that there's a difference between the par value and the market value, you should automatically acknowledge that there is some sort of additional paid-in capital involved with this deal. So here's one way I recommend you sort of break down the analysis. The number of shares issued, 5,000. Price per share, fair value, is $12. The fair value given in this case to the seller, therefore, must be the $60,000. So I'm giving somebody a bunch of stock certificates worth $60,000 as of the date of the transaction. The seller can take that and go on the market and sell those immediately to get approximately $60,000 in cash. So issuing stock instead of cash is a great way of saving cash flow, and while also being able to enter into a fair transaction. Well, once we do that, we know that the fair value of the land down below is $60,000. So we gave $60,000 in fair value, so therefore the land is worth $60,000. But we have to break out the $60,000 between par value and additional paid-in capital, which is just a plugged figure in this case. So again, $5,000 or 5,000 shares, times $10 per share par value. Overall par value issued is $50,000. Well, $60,000 is what we gave, or should I say $60,000 is what we received in value. What we issued was $50,000 in par value, and therefore it must be the other portion is $10,000 in additional paid-in capital. So basically, if you want to just come down here, you can simply say it's the 5K in shares times the $10 par value, 50,000. And you see in this case that we must need a $10,000 plug figure for additional paid-in capital. And that's about as complicated as I want to make it for this particular topic. Now, the more complicated one, or at least what people tend to view as the more complicated transaction, is an exchange of non-monetary assets, or what I like to call ENMA, exchange of non-monetary assets, ENMA. The fair value of the asset given up, or the fair market value of the asset received. Whichever one is clearly more evident or obvious, that's what determines the overall cost basis, of asset received. Okay. So how do we know which one to use? Do we determine the fair value? Do we use the fair value of the asset we've given, or do we use the fair value of the asset received? Well, generally speaking, here's the thing. Don't overthink this too much. If we engage in a transaction with somebody, okay, the value that we give is going to equal the value that we receive. In common law, no one other than the two parties involved determines whether or not whether the exchange has mutual assent and whether or not the consideration exchange has equal value. If it doesn't have equal value, we negotiate. If it doesn't have equal value after we negotiate, we walk away. So just realize that the value of the asset we give should equal the very fair market value that we receive. Nevertheless, the FASB has some particular rules with regard to enema transactions. So down below, here's one of the first things we need to consider: whether or not an exchange has commercial substance. An exchange has commercial substance if the future cash flows change as a result of the transaction. Well, specifically, what does that mean? If a transaction has commercial substance, then essentially both parties, or should I say that's not both parties, economic position, economic position changes. Okay? And in a lot of ways, that means that somebody is definitely better off. Someone is better off because of the transaction. Okay? But if an exchange lacks commercial substance, then we can say that neither party is better or worse off. Okay? Here's another way to sort of look at this. If a transaction lacks commercial substance, excuse me, it essentially means that we've kind of engaged in a rather subjective valuation of assets received and assets given. If the transaction has commercial substance, it's actually a lot more, the fair values are actually a lot more objective. They can be verified objectively. Okay? Another way of sort of looking at this is if a transaction lacks commercial substance, think about family exchanges of, say, for instance, cars. Okay? If I've got a used car and my brother has a used car and we engage in a non-monetary transaction, it's very difficult to determine whether or not the value I've given equals the value that I received, especially if there's also cash that I kick in to him or if he kicks cash in to me. So generally speaking, the FASB doesn't really like these type of non-commercial substance transactions because the value is kind of difficult to determine objectively. Whereas if a transaction has commercial substance, it usually means, hey, look, I went to a car dealer, they offered me this car at this price, I bought it. Generally speaking, I can say that the value that I received is objective and it's a fair value. But if I buy a car from my brother, depending on what he charges me, it's not very objective. Maybe he gives me a really good price. Or maybe I just give him, if we exchange cars, maybe my car is shit and his car is shit, and we enter into a shit for shit transaction. So sometimes I call this shit for shit. He gives me a bucket and I give him a bucket, and we pedal off in our own ways. So here's what it comes down to, what the FASB says. If a transaction has commercial substance, then the buyer, in this case us, if we're the party of interest, right? The asset that we receive versus the asset we give, if there is any gain or loss in the transaction, then those need to be recognized immediately. But if I'm dealing with a transaction with my brother that lacks commercial substance, if somehow I'm better off, I have a gain in this case, I must defer it. Don't recognize immediately. However, if I do recognize a loss in my exchange with my brother, then in that case, I will recognize a loss immediately. Silly little rules, but in general, it's meant to protect, in this situation, any recording of gains at unreasonable or unverifiable price levels or fair value levels. So I've created a bunch of different scenarios for you. And the first three scenarios will look at situations where a transaction has commercial substance. So information processing trades its used machine for a new model, a new machine, and the exchange has commercial substance. The used machine has a book value of 8,000. This is on our books, our machine. IP's machine, our. We are IP. We are IP. We are IP, and our machine has a book value of $8,000, which is a cost basis, what we paid for it a long time ago for $12,000, and $4,000 of accumulated depreciation. We acknowledge that there is a fair market value if we post it on Craigslist. Let's say our machine has a fair market value of $6,000. The new model that we're getting has a list price of 16, which means that that's what the seller is offering to all parties. So that's one of the ways we can sort of say it has commercial substance. This is an objective sort of transaction. Arm's length transaction is another way of saying objective transaction. The seller gives us a trade-in allowance of $9,000. That's the fair value of what our used machine is to the seller. And granted, that's different than our fair value, but let's go through and analyze all these numbers in a second. But essentially what it's saying is that if the list price is 16,000 and the allowance, the trade-in allowance is 9,000, then essentially we have to bring to the table $7,000 or cut a check for $7,000 to get the machine. And that's what's set up here. $7,000 is due at the end of the transaction. So, giving me the machine, price of 16, I'm giving the seller $9,000 trade-in value for my old machine, and I'm also giving the seller $7,000. On my books, now this is kind of like fair value stuff down below, but on my books, what am I giving? Well, the net book value of the equipment is $8,000. So over here, net book value of the equipment given, 8,000, and I'm cutting a check for another 7,000. So I can say that on my books, objectively, what I would see is I'm getting rid of essentially net credits of $15,000. So what am I getting in return? Is it 16? Is it some sort of combination of all these? What is it? Well, I've determined from this transaction that I am objectively on my books, in my general ledger, $15,000 of value is going away. Down below, what I'm showing you is what is the value being received. So the old equipment has a trade-in value of $9,000. That's what the seller is willing to give me. But the fair value, what I see on Craigslist, is $6,000. So is the seller really giving me cutting me a break here? I think he is. So the fair value, the trade-in value to the seller is $9,000. The fair value on Craigslist is $6,000. So I can say that essentially the seller is giving me kind of a price discount of $3,000. The seller doesn't have to offer me $9,000. Seller can offer me $6,000 because sellers go on kellybluebook.com and they do their own appraisal as well. So in this case, I'm looking at this $9,000 saying, you're kind of offering me a very generous deal on this trade-in value. You wouldn't really see this at a car dealership, let's just say. Believe me, in my experience, you wouldn't. But if this price discount is extra amount here is value that I'm being given in return, then essentially what I can say is, well, the new equipment, it may have a price of $16,000, but the seller's kind of cutting me in, giving me a discount of $3,000, an excess in trade-in value than he necessarily needs to. So the total fair value in this case, total fair value received, is $13,000. Interesting, because when I look at the fair value received and I compare that to the total fair value given of 15, what I can see here is that essentially I'm giving 15,000, I'm getting 13,000, so that must mean I have a loss of $2,000. And that's what I have to record in my books down below. The equipment, the new equipment, I'm going to value that at the $13,000. That's the fair value that I received. The accumulated depreciation of the old equipment and the cost basis, that is the $8,000 net credit that's getting off my books. And there is the cash I'm paying. So when I look at this, essentially $7,000 credit, there's $15,000 worth of credit entry. I've got a $13,000 debit entry. I must need this plug figure here of $2,000, and it's a debit. So in this case, it's a loss, not an expense, but a loss. So now what I want to do is compare that to some other transactions. Similar facts, but I'm going to change one number in this case. So let's go to the next tab here. I've got a situation where, again, it's scenario 2 with commercial substance, but what I've changed here is I've brought the cash payment down from $7,000 to $5,000. So it's a decrease. I'm decreasing cash by $2,000. Okay. So if I do that, all facts the same, there's the $13,000 again in fair value received. Compare that now to the new fair value I am giving to the seller of, in this case, now it's $13,000. When I compare those two, I have no loss or gain. I can say that I have an even transaction. I'm breaking even in this situation. So down below, the equipment I'll still show as $13,000. The book value of the equipment I'm giving is the $8,000 offloaded. And in this case, I'm only paying $5,000 in cash. So the total amount of credit in this case is $13,000. Total amount of debit is 13. So I have neither a loss nor a gain. I'm breaking even in this case. Down below, I look at scenario number 3. Scenario number 3, I reduce the cash now, down to $4,000. It was $7,000. Previous example was $5,000. Now I'm simply saying, I'll give you my equipment and another $4,000. If that's the case, when I compare the fair value received with the overall fair value given, I can see in this case that I actually have a gain of $1,000. Not too bad. So down below, same inputs as below. There's my equipment, new, $13,000. The book value, I'm offloading $8,000 worth of credit there. Another $4,000 worth of credit. And those sum up to $12,000. But I'm receiving $13,000. So that must mean, hey, I got a gain on this sale. Hey. So here's the next series of scenarios I want to go through. Again, another enema transaction. In this case, it lacks commercial substance. So this is kind of like the shit for shit transaction we talked about earlier. Or imagine I'm selling to a family member. It's like I'm engaged with a family member. So imagine in this case, it's not objective. Okay, it's not an arm's length transaction. So this is scenario 4. Now, I'm kind of going back to the original numbers. Cash payment is still $7,000. Okay, the fair market value I receive is 13, and I compare that to the fair value given of 15. In this case, I do have a loss of $2,000. Okay, same with scenario 1. So down below, what you see is this is the exact same journal entry, same as scenario 1. There's no difference. If we incur a loss on a non-monetary asset exchange or an enema transaction, anytime we incur a loss, we must record that loss. We must. In scenario 5, can I compare that to scenario number 2, where I have $5,000 of cash that I'm giving up, in which case there is no gain or loss. In this case, we're breaking even. The transaction is the same as scenario 2. No difference there. It was a fair transaction with my brother. In scenario number 6, this is the tricky one. I'm giving cash of $4,000 to my brother, okay, as well as something with a net book value worth of $8,000. So total value, total value given, $12,000 in this case. So $13,000 is what I'm receiving. So it looks like a gain. I'm getting a gain on this transaction of $1,000. He. I screwed over my brother. No, not exactly. This is the problem when you enter into one of these subjective type of transactions. The FASB doesn't like it when we show these sort of weird-looking gains that we probably wouldn't have gotten from a more objective third-party arm's-length transaction. This is like a related party transaction. So maybe I deflate the overall value I give to my brother just so that way my income statement looks awesome. Maybe I'm trying to meet or beat analyst expectations of my net income, right? So this gain is sort of like this he, right? Can I get away with this? No. The FASB says this transaction lacks commercial substance. This is a subjective transaction. So down below, yes, you'll still record the $8,000 worth of credit for net book value, and you have your $4,000 overall cash you paid. But you are not permitted to show any gain in a transaction that lacks commercial substance. So what do we do with this $1,000? Guess what? We net it inside this $12,000 cost basis of equipment. In other words, we acknowledge that there's $13,000 of value received, but I'm deferring the gain. I'm deferring this $1,000 gain. I'm taking that out so that way I only show a book value, a cost basis of $12,000. And that's what the FASB views as fair in a transaction that lacks commercial substance. All right, so let's look at some other example here. Okay, Santana Company exchanged equipment used in its manufacturing, operations, plus it also gave $2,000 in cash for similar equipment used in the operations of Delaware Company. So in this case, it's used equipment for used equipment. The following information pertains to the exchange. Equipment on Santana. We'll look at Santana first. There's their cost basis. There is Santana's accumulated depreciation, the fair value, and here is the cash, in this case, the cash paid versus the cash received. So let's take a look at this down below. It's going to ask, prepare journal entries to record the exchange of both companies. We're going to look at both perspectives. So in the case of Santana, let's do some analysis here. In the case of Santana has equipment cost $28.19. So there you see it down below there, which means it has a net book value of $9,000. Okay. So put that $9,000 over here as part of the book value given. There's also book value given of $2,000 in cash for a total value given of $11,000. What's the value that's being received? Well, you can scroll back up here. You can see that the fair value of the equipment that Delaware is giving is $15,500. So down below, that's where we put the $15,500. And we'll assume that there's no discounts being offered in this case, no trade-in values, etc. So the total fair value that I'm receiving, we'll just say, is $15,500. Okay. And when we look at these in comparison, right, $15,500 is what I'm getting, and the amount that I'm giving is $11,000. So what's the difference in this case? Well, this looks like a gain, potentially, of $4,500. The question comes down to this. Is this a transaction that lacks commercial substance or has commercial substance? Well, that's what I want to show you down below. In the case where the transaction has commercial substance, what we will record is $15,500 as the overall value of the equipment received. Accumulated depreciation is removed from the books, $19,000, as well as equipment, $28,000. Cash received, or excuse me, in this case, cash paid, $2,000. I need a plug, in this case, a gain of $4,500. Why am I showing a gain in this situation? Because this transaction has commercial substance. It's objective. It's with it's an arm's length transaction. It's objective. It doesn't involve family. Anybody would probably be offered this type of transaction, so this gain seems fair. It's objective. But what if Delaware is a family member of Santana? Let's assume it lacks substance. Say Delaware is bro or bruh or cousin or whatever. It's a family member, let's just say. Okay, so down below, we cannot show the gain in this case. We still have to do our transaction as per usual, where we say $19,000 accumulated depreciation. We get rid of that. We get rid of the cost basis, $28,000. We show that we paid cash of $2,000. Okay, the $4,500 gain is netted. It's netted with the fair value of the equipment. So in this case, $15,500 minus the $4,500 means I'm going to show a cost basis in this transaction of $11,000. Why? Because it was a transaction with a family member. I'm not going to show a gain on my income statement because I did a transaction with my brother, right? That may look a little bit devious if I show that gain. So it makes sense to simply say, hey, look, reduce the basis, the cost basis on the equipment by whatever gain you would have recognized. Now let's look at Delaware. Let's look at the other side of the transaction. And as part of our analysis, we can see that Delaware's overall book value that they're giving up is $18,000. Right? They receive cash. They didn't get cash in this case. So just sort of like put a little X there. Take the $18,000 and plug that sucker right there. $18,000 is coming off the books. There's no cash payment, so the overall amount coming off the books is $18,000. What about the value that's being received? Well, in this case, what we've got here is a fair value of the equipment that's on Santana's books of $13,500. So $13,500 is what we consider the fair value of the equipment that's being received. There's no price discounts offered in this case, so we can look and say that the fair value of the cost, the fair value of the equipment or the cost basis of the equipment received is $13,500. Okay, the cash that's received is separate. It's a separate transaction. We will record that in Delaware's cash T accounts. So the total fair value in this case received is $15,500. Part of it was in the form of equipment received. Part of it was in the form of cash received. So a little bit different in this case, right? So in this situation, the fair value received, $15,500. We're going to compare that to the fair value given. So in this case, there's a loss. The amount that's being received is less than the value that's being given. So the loss in this case is going to be $2,500. Looks kind of bad. Well, maybe. If Delaware is engaged in a transaction that has, an intimate transaction that has commercial substance, they're going to record the cash as it normally would, $2,000. It's going to record the equipment separately at $13,500. It's going to get rid of, let me skip a line, it's going to get rid of accumulated depreciation of $10,000. It's going to get rid of the cost basis, $28,000, which means it has a plug figure, in this case, the loss and disposal of $2,500. And that's a transaction in a situation where Delaware has engaged in a commercial substance enema transaction. Down below, what's the difference if it lacks commercial substance? Guess what? There is no difference. It's the same. Loss is a loss, right? So losses regardless of commercial substance. You'll always record a loss, always, must. Regardless if the transaction has or lacks commercial substance, you always record the loss.